From military strikes to retaliations to an overall escalation, there are no shortage of geopolitical headwinds coming from the Middle East right now. So, how should investors be thinking about this current environment? Well, who better to ask than Brad Simpson, Chief Wealth Strategist with TD Wealth. Brad, always great to see you. Welcome back to the program.
Hey, it's great to be here.
So we've talked about no shortage of concerns. We've all been watching the Middle East very carefully. How is the situation actually influencing overall risk sentiment?
Well, if you think that all this started, let's call it somewhere between 12 to 14 days ago, and if you looked where markets are right now, you'd think that it's already come and gone. And so, of anything, I would think that the market is and risk is markets are handling this unbelievably well. I brought a chart along. Maybe I think this is a great way to kind of set the tone for this part of the discussion, and I think the title says it all. Is despite tensions in the Middle East, fear is out and greed is back. So this is our greed and fear index, and while it's not in the full on the dark green, it's a light green, and this is a market that continues to perform with unbelievable strength. And so, like the bottom line is this is a market that's addicted to headlines, and I've never seen such short-termism in a market before. And I think I'm accounting a lot of it as many people associate war today like it's like a video game, and they don't understand the limitations, in particular of air power, which has been a big part of the war here, with U.S. involvement in Iran with Israel. And folks who were adults in the 1970s have a more cautious view when they hear leaders tell them that the end of the war is here or that it's near. I've been thinking a lot about this the last few days. That back in the 1960s, during the Vietnam War, the Johnson administration in 1967 was making all these claims that the Vietnam War was coming to an end. And General Westmoreland, the U.S. commander in Vietnam, has this really historically important speech where he was speaking to the National Press Club in 1967, and he made this announcement saying, the end of this near is war, and then the end of the war is near, and then the Secretary of State Robert McNamara came out and said the same thing. And a couple months later, one of the largest counteroffensives from North Vietnam, called the Tet Offensive, occurred, and it kept the war going on for years. And I guess why I'm sharing that is that many folks have kind of forgotten those things, and they hear what leaders say and go, oh well, gee, it must be off to the next thing. And war is a lot of things, but certain it isn't, and a lot of things can happen that you don't expect are going to happen.
So we do have the short-termism in the markets. I mean, April seems like a million years ago. It was only a couple months ago. Are the markets right now, given all the risk we have out there, underpricing this geopolitical risk?
Well, I think if you step back a little bit, I mean, there are reasons to see why you're seeing a less of an impact this time around. And I think a good one is to start out with is the U.S. economy. And the U.S. economy is far less dependent and intensive on oil than it has been in the past. I guess if we're going, kind of going nuts on history here a little bit, but if you go back to 1975, which many of us associate kind of the peak oil in the 70s, is it took 2.8 barrels of oil a day basically to generate $1 million of U.S. GDP. By 2023, that figure declined by 70%. And a lot of that is because industrial efficiency is much better. And of course, we have a far more service-oriented economy in the United States than we did back in the mid-1970s. Now, another reason is a big change is that OPEC had really picked up its production of oil, and this was creating excess capacity, and a lot more can be brought on as well. And so I think that's another reason. And I think if you look back in hindsight, when OPEC did make these decisions over the recent months and gradually increasing production, it's actually quite a brilliant move for oil markets and kind of less of an impact of what's going on. And I think the last one is reality is there's kind of a consensus view is that Iran's military strength is suffered in an awful lot of damage here in the last few weeks. And while they have retaliatory means to build through missiles and proxies, but those are incredibly limited as well. And so the situation remains very volatile there, and there's all kinds of threats that could happen. But at the end of the day, much of this is contained, and much of the potential impact on the economy is much different than some of the big oil wars that we saw and conflicts that we saw in the 70s.
So that helps us understand the moment we're in and perhaps why the markets haven't had that kind of risk approach or risk reaction to all this. Still, in times like these, we talk about potential blind spots. We like to think, obviously, as investors, that we're seeing everything in front of us. What are some of those potential blind spots in an environment like this?
Well, I think the starting one is, in overconfidence in models and narratives by decision makers. We've priced in all the risks is something you'll often see policymakers say in times like this, and this usually and very often can lead to a negative outcome down the road. Leaders also tend to underweight low probability events and high impact events when they see things going their way. And often when in investment terms, people often take a look at past asset correlations and expect the same correlations as they move forward. And we've seen sort of some of the limitations of that as well, with really increased correlation between stocks and bonds. So I think that thinking about those blind spots, I think as an allocator of capital and somebody who's a risk manager, I think you got to run stress tests for unthinkable scenarios, and you got to really make sure that you're truly diversified. And you also got to know how you're going to make decisions when uncertain things occur. And I think if you do that, I think you're going to be in a pretty good position.
Making those decisions in times of this kind of global stress, it makes me think of like personal stress. Like people see some of these moves, and I think what we lived through in April and even the outset of all this, and they make an emotional response. Is it even more critical in times like these when you're allocating capital to take the emotion out of it, to do your homework?
Yeah, I think that the most important part of investment success really does come down to the importance of planning, and kind of reiterate something I just said there, and that is thinking about really being prepared to how you make decisions when uncertain things occur. And the second one is that when you're going into this and I think if we backed up a little bit, is that when we're allocating capital and thinking about being diversified, if you go back and read the things we've been writing for the last 3 or 4 years, and even some of the interviews between you and I, is that we're expecting this sort of stuff now, right? And I also think some of the market reaction to this is we're not the only ones are. We live in a world where there is a lot more potential for war, military interaction between nations, and because of that, we're very much thinking about how do we set up portfolios and being prepared for that.
Brad, we've talked a lot about some of the big global macro concerns right now, asset allocation. I want to start drilling down into different parts of the market. Safe haven assets, gold or treasuries, people often think of them in those terms. What role do they play in portfolio construction?
Well, I think the starting point is you got to split those two apart. And if we think about the bond part of that, is that since the end of the Second World War, so let's call it 1945 till let's call it the last 12 months, that one thing that you could always call immediately is that U.S. bonds were the safe haven asset. And in the environment we are today, that's really starting to change. Now, a big part of that is due to quite volatile policy out of the United States, so that's having an impact. And then, of course, the deficit and debts, which is really starting to mount, is also starting to add question marks around that. Now, I want to be really clear on what I'm saying is we still consider United States Treasuries as an unbelievably safe investment, but there is more friction in that investment than today. Now, of course, the great beneficiary of that then, of course, has been gold. And gold has been, I think we all know, that's been on a big run this year and last year as well. And much of that is folks reducing some of their bond exposure and increasing their gold exposure as a diversified asset, which I think we're very comfortable with that as a concept anyways. And the last part is you'll also see that central banks around the world are doing the same thing. They are aggressively adding gold, and it looks like they'll continue to do so for a good deal period of time as we go forward here as well.
I think you actually have a chart that you brought along with us when we were starting to look at returns in terms of where commodities are, where bonds are, and where some of the part of the equities have been in the market. The year-to-date performance for 2025, and we take a look at what's working more than others, and it's commodities.
Yeah, you see on the far right there is gold being up, but you also see other commodities, and overall has really been one of the big winners for this year. And I know, and I guess I would really kind of hit home on this is that the important part of this isn't just for this year, is that, back at the beginning of 2024, our asset allocation committee added commodity exposure to its strategic asset mix. And we did that really simply is to add a diversifier for an environment where there was more question about what was going to happen with inflation. There was a lot more question of we were going to have a world where we were going to have more military conflict and wars and the things that we are in right now. And the bottom line is that commodities are a excellent diversifier when it comes to times like the one we're living with these conflicts going on. Now, the other part of it is they also just make good sense outside of as a diversifier. One is that we are in the middle of this global infrastructure rebuild, and commodities are going to play a real big part of that. And if you look at defense spending, which is obviously in a big increase right now, that also has a positive impact on commodities. Copper, base metals, titanium, nickel, uranium, rare earths, all of those are going to have an impact. And for that reason, we think that to help with building a better diversified portfolio, that we think adding commodities makes a lot of sense, and a lot of folks just aren't allocated there.
Let's go through some of the asset classes. We talk a lot about stocks and bonds. We have a third, alts, in there, but we'll start with the equities first. What's the mindset here?
Well, I think the starting point is that we continue to be modest overweight, and it kind of comes to full circle where we originally start talking. This is a market that continues to build the flow assets to more risk-oriented assets, and there's good economic reasons for doing it as well. While we see a slowdown in the U.S. economy, we don't see a recession. While we see a considerable slowdown in the Canadian economy, we see a couple quarters where you could see the economy retract, but we don't see are calling for a recession in 2026. So for both of those reasons, we continue to be overweight, both U.S. and Canada. We also think is that if we could work our way through some of these tariff issues, and if we could bring the temperature down on some of this conflict that we've talked a lot about here today, that as we move forward, we could see the market starting to tilt away from rushing into those big growth names, which we've seen so much again this year, and kind of broadening out and going back where the less expensive names are, that are more based on the economy and where the economy is headed. So we think that is a good probability of where that could be driving equity markets, both in the next 6 to 18 months.
Now, in your graph, we had bonds in terms of year-to-date performance, sort of in the middle of that ecosystem. When I get questions on some of my other shows about bonds, sometimes they wonder about the utility of them in a portfolio. They question 60-40 and whether it still works. So what are we thinking about treasuries?
Well, look, I mean, I've written an awful lot about the shortcomings of the 60-40 portfolio, and it tends to struggle in environments where, if you think interest rates are going to or have any kind of risk of going up, or in an environment where you have the uncertainty like we have in different military fronts. And so for that reason, we think that bonds, we still like them, but think about it in a term of where you're purchasing them more today for the coupon return. Also, you got to remember that they are a guarantee, so they return your capital back to them. So I think that's another part you've also got to consider. But overall, we think that there are other areas where we can have potential for a better rate of return that will also add for a better diversification benefit.
I think that leads us into alts. People are familiar with the stock conversation, the bond conversation. We're hearing a lot more about alts. What are our thoughts here?
Yeah, well, so one is that we think a great place if you're not going out with bonds and going out and adding duration, that means going longer term. One of the areas you can add duration risk is by investing in infrastructure. Infrastructure is an asset that is very good with inflation, and is also one that works really well in producing income. And we think that we're going to be for a long time here in the middle of a global infrastructure build. So we think we continue to like that. We also like private equity a lot. This is an environment that bodes really well for secondaries, and that secondary market has very good valuations today. It's been very difficult in difficult times in private equity to bring your private equity opportunities to the market. And because of that, the valuations are still really good there. And we think as a long-term investment, that makes a ton of sense.
Oh,
Now,
Brad,
and I guess the
always
last one,
love.
which
Yeah, we'll
oh,
get
go
one
ahead,
more in there.
sorry.
Quick, you got 10 seconds.
Yeah, quick. And I guess the last one is this: is that making sure in your equity portfolio is that you're using long-short strategies and you're doing hedging. And I think if you're doing that, if you really do have a truly well-diversified investment portfolio for an environment like we're in.